Bitcoin breaks $100,000, what it means for your portfolio. Cryptocurrency is no longer just a speculative corner of the market. It used to feel a bit like the Wild West, volatile, unregulated, and understood mostly by tech enthusiasts or early adopters willing to take big risks. For most people, and frankly for most financial advisors, it was even considered a fringe investment that was based more on speculation than strategy. Today, however, with Bitcoin trading well above 100K and institutional adoption accelerating, crypto is no longer something we can ignore. It's now moving into the financial mainstream, and that shift brings opportunity. Today, I want to walk you through what's driving crypto's shift towards mainstream adoption, what new regulations mean for investors, and how this could impact portfolios going forward. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's take a look at how the crypto landscape has evolved over the last 10 to 20 years. For much of the last decade, crypto was treated a lot like gambling. Most investors would buy Bitcoin or Ethereum, hoping it was the cheat code to getting rich. But there wasn't much infrastructure or regulation to support widespread adoption. Even as recently as late 2024, the Pew Research Center reported that most Americans didn't trust crypto. The view was that it was too volatile, too unregulated, and overall, too risky. And yet, the numbers tell a different story. Ownership is climbing fast. Back in 2022, the Federal Reserve of St. Louis reported that just 4.3% of American adults owned crypto. But by early 2025, that number jumped to 20%, according to research from the Harris Poll. And what's even crazier is that 39% of those crypto owners are using their digital assets for real-world purchases. We're no longer talking about trading crypto on an app anymore. People are actually paying for goods and services, which signals utility and adoption, not just speculation. On a global scale, things are even more dramatic. The global crypto market cap is approaching $4 trillion, up 66% since the 2024 US election. That wasn't that long ago. Bitcoin alone now accounts for $2.3 trillion of that, with Ethereum at around $456 billion. So what does this tell us? Well, it may be approaching a tipping point where innovations move from an early adoption phase into the financial mainstream. Think of how smartphones or online banking went from optional to standard once adoption crossed a certain level. Crypto looks like it's heading towards that same inflection point, with over 10% of global reach in developed countries by the end of 2025. A key development driving this change is regulatory clarity. One of the biggest criticisms of crypto over the years has been the uncertainty surrounding regulation. For investors and advisors alike, unclear rules created hesitation. But now, that's all starting to change. The recently passed Genius Act is one of the most important pieces of crypto legislation that we've ever seen. It establishes rules specifically for stablecoins, which is a type of cryptocurrency pegged to assets like the US dollar or gold. This is a huge move for the industry, since stablecoins provide a bridge between traditional finance and crypto, giving people a way to use digital currency without taking on extreme price swings. The Genius Act not only protects consumers, but also sets the stage for banks and financial institutions to safely manage and store cryptocurrency. In fact, now, banks no longer need formal government approvals to offer crypto services, and we're already seeing major players like JP Morgan, Bank of America, and Citigroup announcing their intention to explore creating their own stablecoins. JP Morgan has even announced plans to develop a deposit token specifically for institutional payments. So why is this a big deal? Well, because when traditional banks start building infrastructure around crypto, it legitimizes the space and paves the way for new financial products to be designed for retail investors. Now, let's look at how investment products and institutional adoption have evolved over time. While institutional interest in crypto is rising, it's still early. Right now, less than 5% of spot Bitcoin ETF assets are held by pension funds, and hedge funds and wealth managers account for only about 10 to 15%. Still, momentum is building. In the first half of 2025 alone, about $50 billion has flowed into Bitcoin ETFs. And BlackRock's iShares Bitcoin Trust already has $80 billion in assets under management. This makes it the largest crypto ETF on the market. This is important because regulated products like Bitcoin and Ethereum ETFs make it much easier for investors to access crypto, and they can use it through familiar and trusted channels. Most financial advisors still have limited access to direct crypto custody, but ETFs and crypto trusts provide a bridge that gives investors exposure without having to directly hold or secure the digital assets themselves, which can be a complicated process. And as more regulated investment vehicles come online, we can expect access to become even easier, safer, and more common, similar to how decades ago mutual funds and ETFs completely transformed equity markets and equity investing itself. All of this begs the question, should crypto be in your portfolio? Well, crypto remains volatile, more so than stocks and bonds. Even as Bitcoin's volatility has come down in recent years and it's gotten more capitalized, it still experiences larger price swings compared to something like the S&P 500. However, the correlation between the S&P 500 has been increasing, which means that crypto isn't for everyone. But for aggressive investors who can handle risk and have a long-term horizon, crypto is becoming an increasingly viable asset class. It can provide diversification, growth potential, and increasing liquidity, which all make it worth considering. At Pacific Wealth Management, we've been analyzing and researching crypto for quite a while. While we don't believe it's appropriate for every investor, it's clear that it's maturing. And as infrastructure and regulations improve, we expect to see better investment alternatives with more flexibility and liquidity, something we'll continue to monitor closely for our clients. Let's wrap this up with a few key takeaways. 1. Crypto ownership is rising quickly. 20% of US adults now own crypto, and nearly 40% of those are actually using it to pay for goods and services, making it increasingly a part of the financial mainstream. 2. Regulatory clarity is improving. Regulation, including the Genius Act, is providing the kind of guardrails investors have been waiting for. 3. Institutions are now getting involved. Major institutions are now building stablecoins, ETFs, and other crypto-related products, making crypto less risky and more accessible than ever before. 4. Portfolio inclusion is increasing. While still volatile, crypto is evolving into a legitimate investment option for aggressive investors looking for growth and diversification. Cryptocurrency is no longer just an experiment. It's a growing part of the financial ecosystem. For investors, the question is shifting from if crypto will be relevant to how it should fit into a well-thought-out investment strategy. At Pacific Wealth Management, we're committed to analyzing these opportunities carefully, keeping risk and long-term goals at the center of every decision. I'm Justin Kuntz, Managing Director at Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, make sure to visit us at www.pacwealth.com. Thanks.